Good afternoon, everyone. We are ready to start the third section of our online seminar dedicated now to the high-yield investment ideas. But first of all, let me present myself. My name is Alessandro Lombardo. I am the head of the Cbonds International Department, and I am located in the sunny Genoa, in the northern part of Italy. Well, you cannot see it because my curtains are closed, but I promise it's sunny. I would like to thank you, and I would like to thank all the speakers that managed today to attend our online seminar, which is really unique because, you know, when you can have a very comprehensive overview of the current worldwide situation, and you can understand also what is influencing the financial market, it is really, really interesting. Because the financial market, let's say, it's a very precise mirror of any geopolitical event which is occurring in this moment. So we are as well going to present the Cbonds fixed income and research and analysis platform, of course. We are going to seek together for some high yield bonds. We're going to show you as well some interesting tools with Lana that will connect again afterwards. But let's now continue our interesting financial trip, let's say, around the world. Let me present you Mr. Haitham Abdulla. Haitham is a unit head investment solutions treasury in the National Bank of Fujairah. He's connecting from Dubai, directly from Dubai, and he will speak about the role of high yield bonds in a multi-asset portfolio and how it is possible also to identify opportunities in the high yield market. So Haitham is going to give his overview of the current situation, in what way it is influencing, let's say, the high yield side of the bond market, and what could be, from his point of view, what could be some interesting investment ideas for 2022. I also remember to all participants to feel free to ask other questions. We are going to ask to Haitham everything you want to know from him. So we can start. Abdulla, I am aware that you are going to cover multi-asset strategies that allocate across equities, bonds, mutual funds. So we will be glad to hear your opinion about the role of the high yield bonds in a multi-asset portfolio, various strategies of high yield bonds that you focus on now, your bank focus on now, how to identify opportunities in the high yield market, and what to look for when selecting a high-yield bond fund manager.
Thank you, Alessandro, for the introduction. It's quite interesting times that we're here talking about such asset classes, especially in the face of the turmoil and volatility that the market is experiencing. I'll start off about introducing myself. I lead the investment solutions unit. Our main focus is constructing multi-asset strategies for our clients. And in here, we're talking about investing into equities, fixed income through various fund managers that provide exposure to each asset class. When we construct any client portfolio, we always seek and aim to have different asset classes in that portfolio. One of them, obviously, is high-yield bonds. One of the main things that we consider when looking into any asset class and how does it fit within the composition of the portfolio is how would it impact the return of the portfolio, and two, how does it impact the volatility and the risk of such portfolio. And the third part is we look also to the correlation of the additional asset class in relation to the other asset classes to the portfolio. Now, when we speak about high yield, I think it's an asset class that's quite interesting. It's an asset class that sits at the higher end of the risk spectrum for fixed income, but it also is considered lower risk than equity. So I consider that it's something that's in between to equity and fixed income. It usually has a very high correlation to equity returns, and that is specifically during market downturns. So let's take an example during market turmoil, or when the markets are in a downtrend or there's a market shock. What you will usually see is that equities will have negative returns, and that high yield bonds will also have negative returns. However, when that's not the case, then you would have the additional value coming in from the diversification, and you will see that that correlation is not as high. Now, how does global high yield come into play when being set in a multi-asset portfolio? Now, for every client or for every strategy, we always capture the risk parameters and the risk that the client is comfortable with. Obviously, with high yield being considered a risky asset, that basically sets the tone and determines how much exposure to high yield we set into that client's portfolio. Now, there are instances where clients choose to completely take out high yield from their portfolios. However, there are instances where clients are actually seeking high returns, and that's where they add even more exposure to their portfolios. Talking about high yield, one of the main things we look into when assessing exposure to high yield. See, the thing about high yield is that high yield is something where you want to basically avoid losers. You're buying the bonds trying to avoid default. Yes, they are generating that wide credit spread. You're basically buying the high yield exposure to capture that high credit spread. However, one of your main concerns when managing a high yield portfolio is trying to avoid the losers. And to that, there are many aspects that we look into for that. One of them, we usually start, if it's a top-down approach, we look at, for example, the sector that entity is operating in. Is it a sector that's facing any downturns? Is it a cyclical sector, or is it a more stable sector? Is the risk of the bond coming in from the sector itself or the company itself? That's one area that we look into when assessing high yield bonds. Another thing is also we look into the sovereign risk of the countries. Now, high yield is something that's considered a wide asset class. Not high yield is created equal. Now, from our view, typically there are two main areas of high yield that we focus on. One is emerging market debt. Looking at sovereign emerging market issuances, a lot of them are rated at basically BB plus or below, which is considered high yield. So that's one area to look into. When we look into that asset class, typically our approach is about how well positioned that country or that sovereign in terms of its financials, ability to pay its debt, ability to refinance. And these are some of the key components. When it comes to emerging markets specifically, I don't think emerging markets as a whole are equal. Again, I think there are a lot of differences, and one has to be very selective when selecting emerging market debt. For example, you have some countries that are considered oil exporters. So especially as it is the case right now, they would be quite lucrative and quite interesting to look into, given that oil prices are at a level where we've seen it's at above $100. And if oil continues to be at that level, these countries would do well and their financials would improve significantly. However, on the other side, there are also countries that are oil importers. So it's very important to assess that. If we dig even deeper into the emerging market space, you can see that there are some countries that are highly dependent on commodity prices, while other countries are highly dependent on importing commodities. So it's very, I would say, diverse, and it's very wide when it comes to the emerging market space, because different countries would have different aspects. So it's very difficult to say that I'm bullish on emerging market or I'm not bullish on emerging market. I think that we have to be a bit more specific on that. Moving on to the other side of high yield that we find quite interesting is the global corporate high yield. Again, every segment of this asset class has different, I would say, different returns and risk profiles. Here are some numbers that I've had look into. Basically, the credit spread right now on global high yield sits around the 420 basis points. However, when you dig deeper and break it down by region, you can see that European and the US high yield, they both stay at around between the 300 to 370 basis point credit spread. While if you look at the emerging market high yield, you would see it, the credit spread will be around 650 to 750 basis points. We see this as a huge divergence between the two regions. Hence why we always look into emerging markets separately from developed market high yield. What we always try to do is we like to always have a highly diversified exposure. So within our client portfolio, they'd have exposure to European high yield, they'd have exposure to US high yield, and they also have exposure to emerging market high yield debt. However, when it comes to emerging market, because of the nature of emerging markets, and there is a lot of challenges, especially when it comes to regulations and understanding the dynamics of emerging markets, we typically prefer to remain on the sovereign side and not take corporate risk on that space. However, on the developed markets, typically we're a bit more comfortable taking corporate high yield exposure. However, some of the interesting facts we came across is that one has to really look into the covenants of such high yield issuance. What we've noticed from our experience is that in US high yield, the spreads are higher. However, the covenants of the bond issuance are typically lighter, meaning that they are more in favor of the issuer, not the bondholder. The case is in reverse. In Europe, most of the covenants are actually in favor of the bondholder, and the regulatory framework supports the bondholder and is more stringent on the issuer. So these are some of the main elements we came across during our basically work with high yield. In general, when we come to identify how we want to build our exposure to high yield, one of the main instruments we use exposure through funds and fund managers. And selecting high yield fund managers is something that I think that requires a lot of diligence. It's not an asset class where you can select basically an index and get exposure to it. You become involved to a lot of risks in that. However, I think the way to go when having exposure to high yield and emerging market is to go through highly concentrated, specialized fund managers. When we look at these fund managers, some of the key areas that we look into, for example, is the track record of that fund manager over a long period of time. We like to also look at the specific timeframes in that track record. For example, during a market shock, how did that fund or that fund manager basically react to these conditions? Did he basically increase her exposure? Did he reduce his exposure? Did he make some changes to the portfolio? What kind of strategy does he follow? Is he a highly active manager or highly passive? In general, from our experience, we noticed that the more active managers tend to outperform, especially during volatile market conditions. But in the long run, they all converge almost close together. There are obviously some outliers, some fund managers that really outperform over the long run. However, what we've noticed is they use derivatives to basically gain short exposure on the bonds, and hence they're able to generate more yield. Another important factor for us when assessing high yield fund managers is their specialization and the fund house that backs them. In general, we like fund houses that really specialize in high yield, and that's their main flagship fund and flagship strategy. We found that these tend to outperform their peers and their counterparts. That's in general some of the main ideas that we look into when we look into high yield fund managers. Alessandro, I'll pass it back to you if you have any questions and any additional points to discuss.
Yeah, thanks. Haitham, I have a few questions I think that would be interesting for you. They are quite general, but in this moment, I think they are absolutely fundamental because let's speak, for example, about a multi-currency diversified portfolio, yes? And as you can imagine, the currency rate exchange plays a fundamental role. So what, from your point of view, could be the currency of the future? What currency should be selected in this moment, from your point of view, in a high yield market portfolio, for example?
Now, when we're talking about currencies and high yield, that's usually a very, I would say, in-depth exercise that we usually have the fund managers do. From our perspective, because all of our investors are dollar-based, we focus on either hedged fund managers or fund managers that actually only take hard currency exposure through the US dollar. However, on the investment grade, we actually do have some allocation to basically other currencies. In general, what we found the best option for our clients is to remain mainly concentrated in the dollar. Now, moving on to your question, what could be the currency of the future? From my personal view, I don't think there will be one world currency. I think each major economy at least will have its main currency that's backed by it. And that goes back to a very fundamental inherent thing about currency. For currencies, you need to basically have a government backing. I know that there's a lot of talk right now about cryptocurrencies, decentralized currencies. However, what we've seen is that during times of crisis, take for example the pandemic in 2020, because the global central banks, the European Central Bank, the Federal Reserve in the US, they had control over the money supply and were able to print money and basically support the economy. We avoided a crisis basically because of that backing of the government backing up their currencies and supporting the money supply, which helped obviously in going through the crisis, going through the pandemic. Take for example in US, there were check handouts that were given to citizens that were unemployed. In Europe, there was also a similar picture. There was support to businesses. All of that was only been able because that the currency is backed by a government. Now, that doesn't mean that digital currencies won't have a place in the future. I think they will. However, I think with innovation, it's the rate of innovation and the rate of adoption that will determine what will be the place of digital currencies in the future. And obviously, the final note would be is that how would the governments of the world react and regulate such currencies? I think if there is enough regulation, they would be widely accepted.
Thanks. Let me ask you one last question. As you know, we work in over 80 countries in this moment as a platform, so we have clients all over the world that follows us today as well, connected from really, I think, more than maybe 30 countries today. And we have a lot of private investors that maybe are not so technically prepared as many important asset managers. So as you can imagine, easy questions usually are the most important ones. So let me ask another question, quite general. So if we need to take from one side the high yield sovereign bonds of an emerging market, and from the other side, we're going to take some high corporate bonds from a developed market. What, from your point of view, which kind of investments could be in this specific moment more profitable, so on a long-term basis, let's say, and more protected from economic and from political risk as well?
In general, yes. In general, our strategy is we do not try to move like on a short-term perspective. Usually, we like to have a very long-term view. And that leads us to having actually both exposure to both asset classes you described. So we would have exposure to developed market corporate high yield as well as emerging market sovereign. However, if we look at specifically this point in time, emerging market sovereign debt is yielding at a much higher yield than if you look at high yield corporate in the developed markets. Now, if we dig a bit deeper, if we want to go to the emerging market sovereign debt, I think one has to be very selective with which country they're getting the exposure to. As I mentioned at the start, not all emerging market debt is equal. You have Latin America, you have the emerging markets, and for example, the Middle East. You go to Asia, Eastern Europe. So I think one needs to be very selective. And I do believe that there are some pockets of opportunity here, and that the bond prices in general would recover with time, as obviously as depending on how the situation will develop. Typically, what happens during a market shock is that all of the asset class all of the asset class declines. That doesn't mean that the whole all of the asset class is actually in reality impacted. Yes, there are certain parts of the asset class that are truly impacted. However, there are certain parts of the asset classes just because by virtue that there is a sell-off and a panic in the market that they have been sold off also. So that gives investors the opportunity to enter and get a very decent yield pickup. Looking on the developed corporate high yield, I think it's more about the business cycle and where we are in the business cycle. And that's usually what determines the credit spreads for that asset class. Now, obviously, with the on that, we would look more on how the central banks would be raising rates and how they would tighten or ease depending on how things move forward. Now there are expectations that the Fed could be tightening just a bit too much towards the end of 2023, and they may have to reduce their tightening and maybe perhaps begin easing, which would be obviously more favorable to corporates. So it's more about where you sit in the business cycle, and that usually determines how much exposure you want to take to that asset class. However, I still do believe that the best way to get exposure to that asset class is by being very selective and concentrated and selecting the sectors that are actually going to be basically in a much favorable condition. For example, if you take a telecom high yield, it's different than taking an energy high yield. So I think, yeah, it's more about what you select from within that asset class more than just a general asset class exposure.
Thank you very much, Haitham. I think a lot of private investors have been taking notes while you're speaking, because these are really interesting insights. Thank you very much. So you are free. We are fine. I'm going now to continue. Thank you very much, Haitham. We spoke a lot now about possible new investments for 2022, about high yield bonds, but let's also speak about the instruments to find these opportunities. And of course, as head of the international department of Cbonds, I will now introduce you to our fixed income research and analysis platform. So what is the main purpose of our clients using Cbonds platform? And why we have so many clients in so many different countries worldwide? The main purpose is the one of detecting the most interesting and appealing opportunities along the bond market and monitoring these investments in the safest way. So the platform currently provides information on over 600,000 bonds worldwide, 70,000 equities, and 6,000 ETF, as well as a new instrument we just added, with 100% coverage of the Eurobond market and over 350 primary sources of prices. So rating, prices, prospectuses, covenants, new issues, bondholders, financial reports. I could continue for a lot of time. If you are active in the bond market, you absolutely need to have access to all this information in one platform. And with our platform, this is possible. So basically, you will have the bond market fully under control. I will therefore ask to Lana to switch on her camera and microphone once again. Lana works with me in our international department. She is specialized in work with corporate clients and will now, let's say, make a brief presentation of the main tools available in our service. Lana will as well going to share a PDF in the chat and via email as well after the seminar with a proposal of free trial of the platform. In that sense, very important, we would be glad to provide also a personalized Zoom or Teams call, as you prefer, or Skype. We also have Skype, of course, to anyone who is interested to know more about the platform, about the cost of the service. Afterwards, we are going also to open a free trial of the platform for 1 week, and then eventually, of course, find the best solution according to your business, according to your current requirements. So, Lana, feel free to go ahead now.
Thanks a lot, Alessandro. And let me probably start sharing my screen so we could make it just a bit more visual. Probably for those of you who know us for a while but didn't track our upgrades, and we do it very frequently, I would say here in Cbonds you are able to find not only bonds, although this is one of the most interesting data. It is rather challenging to find it. Here you will be able now to find the information on stocks and ETFs. Why it is interesting? Because if with sovereigns the picture is rather clear, but when you analyze the corporate, issuers, you need to have many-sided opinion on their business, on their performance, and basically have all the connections about this. So we spoke about different markets, EM, but among investors, I would say it is rather popular to have a high yield strategy, and high yield bonds, they might be not only in emerging markets, but of course this is probably the key area where we are looking for this. The crucial thing is how to detect them, how to find the most appealing bonds. And let me present you our bond screener. I would say this is one of our most popular tools. Why? And private investors and portfolio managers who manage millions and billions of portfolio like this platform, because you have a global coverage and you have different filters, how you can specify exactly what you're looking for. So as you can see at the platform, it should be rather user-friendly. I will go to our bond search, where you will be able to specify everything what you're looking for and get a clear picture in table and in a chart view. So today we spoke about oil and gas sector as one of the most promising, especially in terms of the prices. So let me make the quick search. Let's do a global search for corporate bonds in oil and gas sector. We are looking for international bonds in hard currency, in USD. If you're looking for liquid bonds, of course, yield should be your target. So let's start with 4% yield and up to 20 is the way for us to avoid the trash options. And let's put the duration between 2 and 10 years as long-term investments should be rather interesting. In case the issue is not rated by all the rating agencies, you can use at least one rating at our platform. And so let's specify, for example, BBB. So it's rather general, I would say, target. So you are able to specify maybe some additional parameters. You're able to search for particular type of the bonds. If you're looking for only green bonds or Sukuk bonds, we mentioned all types. If you want to exclude subordinated bonds to avoid some risk, you're free to do all these. Let's say you're finished with all the filters. You can get all the results. So, for example, here you see all the filters which we applied, and we found 75 positions with high rating and with the high yield. All these data is available in Excel format, so you will be able to integrate and make some calculations as you prefer. Additional value, for example, to be updated, and don't spend much time on this. You're able to save this query, and next time you'll have email with all the updates. So all bonds which match your criteria and they come up at the market, you'll get all these notifications to your email. So, for example, you can, just a second, let me switch to the full screen, so you will be able to see all the bonds. So this is the yield map of our search. I can add some names, so it would be pretty much understandable. As I used USD bonds, I would apply benchmark. So you could see USD Treasury and basically how all these bonds are corresponding to this. You can enlarge the chat, and you could see all the bonds in more details, maybe some particular duration which you prefer. If you like the bond, you're able to simply click on this dot and go directly to this bond page and get all the details which are crucial. Since we aggregate all the data from primary sources, from thousands of them, you get all the data in a structured form, and you can get as much crucial information as possible. You can get all the ratings for the issuer and for the issue from top 3 rating agencies and from local ones. For example, we had Terry in our discussion. They are a highly popular rating agency based in Hong Kong. And trust me, sometimes local guys know just a bit more. So you're able to get all the documentation for the bond. And right now, especially if you have different strategies, for example, if you're chasing for rather risky bonds, you need to pass your compliance, you need to know all the terms as the way for you to eliminate all the risks. So here we are able to provide you the full coverage and the rare database of prospectuses, and for our clients we can make extra searches. It's a part of our personalized service. You're able to visualize the price and yield changes, and in case the bond is rather popular at the market, you will be able to get rather diversified market value from the stock exchanges, from market participants. You can get the average market price by Cbonds estimation. And in case you need to evaluate some historical data, feel free to get our archives, as Cbonds is on the market for 20 years. So we are able to share absolutely deep pricing picture for all these bonds. Sometimes it's just very convenient to evaluate all the issues of particular issue in one currency, and there is a convenient yield map. You can also compare one bond with another one, or you can compare with the index. Additionally, since now we have information about bonds and stocks, you're able to analyze the issuer page. Just a second. You can view the bonds and the stocks at a single page. So you could just get better understanding on the performance of this issuer. There is additionally debt breakdown in different currency in case you want to understand their total debt. You can see the current and the historical rating changes and see the dynamics, how it goes. So you get all the terms, all the cash flow, make whole, and just make sure that your picture is rather clear, because sometimes the data might be just not represented. Additionally, in case the bond is exchanged, and sometimes, for example, right now there were lots of defaults in Asian market, we put all the details for debt servicing or maybe exchange terms. If you want to double check all your and make sure that you have good insurance, we analyze prospectuses and state all the covenants, so you are able to see the links where all this data is stated. And most importantly, when you analyze any kind of bond, try to analyze the appetite at the market, because in case the bond is popular and big institutional funds invest and have these bonds in their portfolio. By the way, we state all this information at the end of the page. You can see the market value and the last date when it was updated. So probably these guys should know more, and probably this bond is, should be among your interest. Additionally, you are able to track all these bonds via different tools such as watchlist. The convenience of this service is that everything can be automatic and you don't need directly to interfere into it. So you create your list of bonds, maybe stocks or indices which you would like to track. You can group them as you wish, like potential or actual portfolio. The most importantly, you can be on vacation or you can just do your job. You can set email alerts and you'll get notifications to your email about absolutely different bond events like changes in ratings, maybe new financial statements of the issuer. And one of my favorite features are price yield triggers. Basically, if you're hunting on the bond and you want to get it by the most profitable price, you can simply put the alert for your targeted yield or price as you prefer, and once the bond hits this target, you'll be warned about it. So the convenience of working with this tool is that it can be accessible anywhere. You don't need some particularly software to be installed. You just need Wi-Fi and that's it. All this data is available at the platform, like I showed you. You can also have convenient mobile app, for example, to track, to check your watch list, or just to have a quick access when you're at the meeting. And in case you do more professional work and you would like to integrate the data in your Excel, maybe you have some applied formulas, or you simply want everything to be done in your own way, how you prefer, you can use Excel add-in. Basically, you install our file and via formulas or via the toolbar which we offer you, you are able to get prices updated automatically, the yields, or maybe have one spreadsheet with CDSs, country risk indicators, as you prefer. So feel free to try this tool, as almost each speaker who presented at this speech. So they're using Cbonds in their work or some additional tools like data feeds. So feel free to take 1 week trial without any income and check what kind of high yield bonds are could be additionally complemented to your portfolio. Alessandro, I think.
Yes, Mana, thanks. It has been great. Yeah, I think that now we are going to take a break. Then we are going to continue afterwards with a very interesting speech. We will have several speakers. We are going to analyze a little bit the situation in Russia. So stay tuned. And now we're going to take a small break. Bye-bye.